Another sector that's down in trade but does pose as an opportunity at this point in time is the oil and gas pack. So let's take a look at that, specifically oil marketing companies that could also be set for a strong first quarter due to a whole host of reasons, in fact, including higher refining margins. Tell you what, we have Soumeet explaining all of that with a detailed analysis.
Well, there are four reasons why Q1 FY26 could turn out to be better for the oil marketing companies on a sequential basis. First is higher refining margin. Now, if you look at the Singapore gross refining margin, which is the Asian benchmark for refining margin, that averaged around the $5.5 per barrel level so far in the first quarter, as against 3.1 that we had seen in the previous quarter. Now, the current GRMs that we are seeing is the highest since the fourth quarter of FY24, and these higher GRMs or higher refining margins could boost the refining segment of the oil marketing companies. Now, generally, every $1 per barrel rise in the refining margins increases IOCL, BPCL and HPCL's EBITDA by anywhere between 14 to 16%. So that is the first factor. The second factor is the marketing segment of the oil marketing companies. Now, on a sequential basis, the marketing margins that the oil marketing companies earn on selling every liter of petrol and diesel, that is also averaging higher in the first quarter of FY26 as compared to the fourth quarter. Now, fuel margins continue to trend at higher levels. Integrated margins, which is the combined margins of both petrol, diesel and ATF, that is standing at around 9.3 rupees per litre as per analyst calculations, as against 6.3 that we had seen in the previous quarter. And every 0.5 rupees per litre increase in the margin increases the EBITDA of IOCL, BPCL and HPCL by anywhere from around 7 to 11%. Now, for HPCL, the delta is much higher because marketing segment contributes much more to the EBITDA as compared to the refining segment. When it comes to inventory, now crude, if you look at fourth quarter, the average crude level was at around $74 per barrel. Q1 FY26, so far the average level of crude is around $67 per barrel, but currently crude is trading at around $75 per barrel. So if you look at these factors and assume that crude remains at around $75 per barrel level, then this means that there would be limited inventory losses. So not much of a negative coming in for the oil marketing companies on the inventory side as well. And lastly, when it comes to the LPG segment, the losses in the fourth quarter of FY25 from the LPG segment was around 247 rupees per cylinder. Now, these losses have reduced to around 177 per cylinder, and this is because there was a price hike of LPG of around 50 rupees per cylinder, and also international prices have increased by around 10 to 13%. So both these factors have led to lower LPG losses as well for the oil marketing companies in the first quarter of FY26, and these four reasons could lead to a better Q1 FY26 for the oil marketing companies as compared to Q4.
Well, absolutely. Thanks, Soumeet, for getting us that update. So looks like the first quarter is going to be better for the oil marketing companies. Now, at this point in time, of course, there's only Nifty consumption and auto that are holding on to a tinge of green, and all the other sectors barring this are holding on to a shade of red at this point in time. Tell you what, let's also put all of this into perspective when it comes to OMCs specifically, because there's a lot of volatility when it comes to crude prices. In fact, we caught up with Prabal Sen, who's the senior research analyst, Indian oil and gas sector institutional equities at ICICI Securities. Let's go across and listen in to understand what he makes of this particular pack as well.
It's pretty unprecedented in terms of what is happening right now and what the potential ramifications could be if other countries also get involved in the conflict. At this point of time, as Soumeet very usefully mentioned, the price of $75, if you look at it in the context of what has happened in the last couple of years, 75 is still about $4 lower than the average crude prices for FY25, and it is well below the last 4-year average, which is, I think, above $81. So to that extent, right now, the prices are still somewhat manageable from a margin perspective and from a pricing perspective. I think the fear really is that the Strait of Hormuz, I think that remains the crucial monitorable over the next couple of weeks. Whether in any circumstance there is an actual disruption of the crude supplies, the LNG supplies, and the product supplies that are coming out of that strait, I think that is what will determine the direction of crude prices really.